Hello everyone, welcome to this video series on AS A-level accounting past paper analysis. And in this video we are going to analyze the past papers of October-November 2021, paper number 11, 12 and 13. So before watching this video, I expect you to be thorough with the syllabus, practice the papers properly, and then you can visit this video, watch this video to see if your answers are correct, and also to see how do I analyze the questions, how you can improve your concepts and then perform better later. If you want to learn accounting, you can go through the watch list of or the playlist of AS A-level financial accounting and AS A-level managerial accounting. And if you want, you can also consider purchasing the online course on AS A-level accounting. So let's begin paper number 11, question number 1. A trader keeps a full set of accounting records. Which statement is correct? Credit notes issued are recorded in the sales journal. This statement is not correct because credit notes are done for sales returns transactions. Sales invoices are recorded in the general journal. Not correct because sales invoices are recorded in the sales journal. Sales account is kept in the general ledger. This statement is correct because the sales ledger will have all your debtor accounts. Purchase ledger will have all your creditor accounts. And the general ledger will have all other accounts. So the sales account will come in the general ledger. The statement is correct. Sales journal is prepared from the entries in the sales ledger. Not correct. In fact, the sales ledger is prepared after the sales journal is prepared. So option C. Question number 2. The total of discount columns in a 3-column cash book where debit side 320, which means discount allowed is 320, and credit side 140. So discount received 140. Which entries were made in these totals when these totals are posted to the nominal ledger? So the discount allowed would be debited to the discount allowed account. So our correct option would be account debited should be discount allowed 320 and account credit should be discount received 140. So option number B. A company sold one of its delivery vehicles for 2,800 after 2 years of use. Original cost of the vehicles was 6,500. The company depreciates its vehicles at a rate of 30% using reducing balance method. What is the profit or loss on disposal? So you can compare the sale value with the net book value. Sale value would be 2,800 as given in the question. Net book value would be 6,500 cost minus 2 years depreciation. So what you can do on your calculator is 6,500 into 70%. You will get the net book value at the end of year 1. Multiplied by 70% again, you will get the net book value at the end of year 2. It's a shortcut of doing it. Or else if this is confusing, you can try to calculate year 1 depreciation, subtract, then calculate year 2 depreciation, and then go ahead and choose the right option. So the net book value is 3185. Comparing net book value and sale value, since the sale value is lower than the net book value, it's a loss of 385, option B. A trader depreciates loose tools using the revaluation method. Which account is credited at the end of the year to record the depreciation on loose tools? So when you maintain an account on revaluation method, you don't have a separate accumulated depreciation for that particular asset. So you will credit that asset itself. Basically, the journal entry would be income statement debit and that asset credit, in this case, loose tools credit. So option number C. Question 5. A business sold one of its non-current assets. The following information relates to this asset: purchase price, depreciation to the date of sale, which means accumulated depreciation, and sale price. What was the effect of this transaction on the net assets in the year of sale? So before selling, the net book value of the asset was 30,000. And when the asset was sold, this net book value of the asset would be reduced by 30,000 because this asset would no more remain with the business. But since the sale value was 60,000, let's assume that this 60,000 was received in cash. So plus 60,000 would be the impact on cash or any other current asset. So what is the net impact of this sale on the net assets? Plus 60 minus 30 plus 30. So option C, increase of 30,000. Which items would be found on the credit side of a sales ledger control account? Irrecoverable debts allowance is not recorded. Bad debts or irrecoverable debts is recorded. Allowance for irrecoverable debts is not recorded. Contra entry is recorded on the credit side. Irrecoverable debts are recorded. Refund to customers is recorded on the debit side. because cash received from customers is on the credit side, but refund back to customers is on the debit side. So 2 and 3, option D. A business omitted discounts allowed of 700 from its trial balance. During the year, a machine had been sold for cash $500, but only the accounting entry made was debit in the bank account. What is the balance on the suspense account before these errors are corrected? So because of the first error, when you don't take discount allowed, which is a debit account in the trial balance, if you don't take it, because of this, suspense will have a debit balance of 700. And because of the second error, the debit effect was recorded in the bank, but the credit effect, which was the credit to disposal account, was not recorded. So because of this error, what would happen is suspense will have a credit balance of not 700, 500. So the net debit in the suspense because of these two errors would be 200. So option A. Question 8. Felix drew $200 out of his bank account in order to top up his petty cash float. When recording this transaction in his cash book, he reversed the entries despite this error. Okay, what do you mean by reversed the entries? The correct entry for this would be petty cash debit, bank credit. But what did he do? He did bank debit, petty cash credit. Okay, he just did it in his cash book. So you wouldn't say that he did petty cash credit, but yes, he did bank debit. Despite this error, the bank balance showing in the cash book was equal to the balance on his bank statement. So if you see, there is an error of $400 here. Bank should have been credited by $400, but he credited by $200, but he debited by $200. So the extra debit in the bank because of this error is $400. Now, despite this error, the bank balance showing in his cash book was equal to the balance on the bank statement. Okay. Well, how was this possible? Now, cash book is showing extra debit 400, and after this, or because of this error, or in spite of this error, still the bank statement balance is equal to cash book balance, which means even in the bank statement, there is some transaction that is leading to extra credit in the bank statement, because in bank statement transactions are recorded on the opposite side. So we have to see which of these options would lead to extra credit in the bank statement of $400. So let's see. There was an uncredited deposit of $200. A deposit that is uncredited would lead to less credit and not extra credit. So out of question, this option. There was an uncredited deposit of $400. Same logic, out of question, this one. There was an unpresented check for $200. Now, because of this, the payment that should have been recorded on the debit or bank statement is not recorded, which means there is less debit, or in other words, there is extra credit, but the amount is not correct. So this is not the correct option, and hence the unpresented check $400 is the correct option. So 8D. Question 9. A business had calculated a draft profit for the year. The following items have been discovered. A customer has been declared bankrupt and is unable to pay the amount they owe. Unsold goods on sale or return basis have been included in inventory. Rent paid in advance has not been included. The owner's cash drawings have been entered into the owner's capital account. Which of these need to be adjusted to calculate the correct profit? The first one, customer has been declared bankrupt and is unable to pay the amount they owe. This has to be adjusted. It has to be recorded as an expense. Unsold goods on sale or return basis have been included in inventory. So this is the correct effect. When some goods are sold on sale or return basis and they have not been sold by your customer to the other customers, that has to be included in the inventory. So the effect is already done. Further, you will not do anything for this transaction. This does not have to be adjusted in the calculation of profit. Third one, rent paid in advance has not been included. In other words, it has not been adjusted. So you will have to adjust for prepaid rent in order to calculate the correct profit. So this will be adjusted. And the owner's cash drawings have been entered into the owner's capital account. This does not have an effect on the income statement profit. So this will not be adjusted. So 1 and 3 are the statements or the transactions that will be adjusted. So option B, 9B. The following information has been extracted from the statement of financial position of a sole trader. Non-current assets, current assets, current liabilities, non-current liabilities, profit for the year, and drawings. What is the balance on the capital account? as of the end of the year. Okay, so we can say that the capital account is equal to assets minus liabilities. So total of the assets would be non-current plus current, which is 162,000. Total of liabilities would be 43,000. So 119,000. So 10B. The profit and the drawings are just given there to probably confuse you. That you don't need really them to calculate your closing capital. Now, if these values were given at the opening date, then I would first calculate my opening capital and then use profit and drawings to calculate my closing capital. But the assets and liabilities are given at the closing date, so we can directly use that to calculate our closing capital. Question number 11. At the start of the year, the balance on a sole trader's capital account was 183,000. During the year, the following took place. Owner introduced a motor vehicle into the business. This had a cost of 90,000 and had a market value of 74,000. Cash drawings were there 15,000. Owner took inventory for personal use. This had a cost of 24,000 and selling price 30,000. After recording these and the profit for the year, the closing balance on the capital account was 265,000. What was the profit for the year? So simply what you can do is, let's prepare the capital account. Now opening balance in the capital account, credit side I would say 183,000, and closing balance in the capital account would come on the debit side 265,000. On the debit side I will have some drawings, and the drawings here would be cash drawings 15,000 and inventory drawings or stock drawings 24,000. Ignore the selling price, always take it at cost. So 15 plus 24, 39,000. The additional capital that he introduced in form of motor vehicle, that will have to be entered on the credit side, motor vehicle. Now, even though originally the motor vehicle was purchased at a cost of 90,000, but when you get it into business, you have to see what is its current market value, and you will enter the entry at that market value. So credit side 74, and now the income statement would be the difference. So it looks like there's a profit. So if we take the total on the debit side and subtract the credit side, so 47,000 will be the difference on the credit side, and hence the option is 11C. Why might a sole trader form a partnership? Probably one of the advantages of partnership, one or more advantages of partnership. So to enable the revaluation of business assets, no, this is not really an advantage that is worth shifting to a partnership business. To have protection of limited liability, no, partnerships also don't enjoy limited liability, or the owners of the partnership firm don't enjoy limited liability. To gain additional capital for the business, yes, compared to a sole trader, partnership firm finds it easy to raise capital because of multiple partners. So D. X and Y are in partnership. The following information relates to the partnership. Current account, start and end. The following transactions took place. Drawings are given. Salary is given. What is the profit for the year before appropriation? What you can do is, you can prepare the current account of the partners. What I'm going to do, I'm not going to prepare a column in a current account where I'll record transactions of both the partners separately. I'll record it together. So let's say X and Y together, debit, and X and Y together on the credit. Balance brought down is at the start of the year 12 plus 6, 18,000. Balance carried down 17,500 minus 4,000, because 4,000 for Y is debit at the end of the year. So 13,500, 13.5. Then drawings is always recorded on the debit of current account. Both the partners' drawings together 32,000. Salary for X, credit side 5,000. Now the profit that the partners would get in the credit of the current account, that we will calculate. So 45,500 is the total on the debit side of X and Y. And when you take the difference, so we will get share of profit. So 45,500 minus 23,000. 22,500 is the residual profit or the share of profit of the partners. But what they are telling you to calculate the profit for the year before appropriation. So what you can do is you can go or reverse the adjustments of the P&L appropriation account. So for the year, profit would be starting with residual profit 22.5, add back the salary 5,000, that's it. If there was interest on capital, I would add back that. If there was interest on drawings, I would subtract that. So 27,500. So 13B. L, M and N were partners sharing profits and losses equally. N's capital account was as follows. Balance brought down. Transfer of current account, it looks like. On the credit side, motor vehicle, probably he took away motor vehicle of the firm, and probably money paid to him through the business bank account. What explained the entries in the capital account? N bought a motor vehicle from the business paying $1,000 more than its book value. No, doesn't look like as if this transaction is correct. Nowhere they've given the book value. So no. N's capital account includes his share of loss on disposal of motor vehicle. Doesn't look like. There's no disposal transaction here. N increased his capital by introducing motor vehicle and paying cash into the bank. In fact, it's the opposite. He's taking motor vehicle and he's taking money from bank. N retired and took the amount due to him in form of motor vehicle and money from bank. This looks like the correct one, and hence 14D. A shareholder sells some ordinary shares for more than he paid for them. What is the effect on the company's statement of financial position? Ordinary share capital account and share premium account. So let's say there's a company, and of that company there's a shareholder who purchased the shares, and he then sold the shares not to the company but in the open market, because a shareholder of ordinary shares, he cannot sell the shares back to the company. He will sell it in the open market. So this company has nothing to do with the transaction that the shareholder does with his shares. So the correct option would be no effect. It does not affect the capital, the premium or any other account of the company's books when the shareholder is selling his shares. So 15D. The equity of X Limited at 30 June 2021 was share capital, share premium, revaluation reserve, general reserve and retained earnings. What was the maximum total dividend that could be paid to shareholders? In order to pay dividend, you will have to use the revenue reserves. So 50,000 and 80,000. Revaluation reserve cannot be used to pay dividend. So 130,000, 16B. The value of inventory for a limited company at 31st May 2020 was overstated by $20,000. What was the effect of this error on the retained earnings? Retained earnings opening and closing. Basically, last year's inventory was overstated. So they're asking you what is the effect on the retained earnings of last year balance and current year's balance. Last year, since the closing inventory was overstated, because of this, gross profit would be overstated, net profit would be overstated, and eventually retained earnings balance will be overstated by 20,000. But when it comes to the current year, this closing inventory overstatement of 20,000 will turn out to be opening inventory being overstated by 20,000 in the current year. Because of that, gross profit will be understated by 20,000, net profit will be understated by 20,000, and current year's retained earnings will also be understated by 20,000. But last year's overstatement and current year's understatement would lead to no effect in the retained earnings. So option A. What are the limitations of using accounting ratios for comparisons between firms in the same industry? Different businesses may have different accounting policies. Yes, that's correct. Let's say, for example, depreciation policy. A firm is following a straight line method while the other firm is following reducing balance method. Their profits could vary, and hence comparison of these firms based on ratios will be difficult. Efficiencies of different businesses cannot be compared. That's not true. You can compare efficiencies of the business using efficiency ratios. Liquidity of the businesses cannot be assessed. That's again not really true. You can assess the liquidity using liquidity ratios. So one only. Abdul is assessing the profitability and efficiency of his business and is using these figures from the financial statements. Non-current assets at cost and at book value, revenue, profit from operations. What is the non-current asset turnover? The formula is revenue upon non-current assets at book value. So 340,000. divided by 53,000. So 6.42 times 19D. The following information was available for a business for the year ended 31st December. Sales, gross margin, rate of inventory turnover, opening inventory. What was the value of closing inventory? Okay, since the gross margin is 20%, so gross profit will be 20% of 400,000, which is 80,000. Cost of sales will be the difference 400,000 minus 80,000, 320,000. And what is the formula of rate of inventory turnover? Cost of sales upon average inventory. Now you have the rate of inventory turnover as 4 times. You have the cost of sales calculated as 320,000. So it means average inventory will be 320,000 divided by 4, 80,000. If opening inventory is 60,000, you will have to calculate what figure of closing inventory will give you an average of 80,000. So the correct option is 100,000, 20C. A manufacturing business is currently operating at full capacity. As a part of expansion program to increase production capacity, business intends to employ an additional factory supervisor. How are the total supervisory salaries classified? Fixed cost, semi-variable cost, stepped up cost, and variable cost. Definitely not variable cost. It is supervisor's cost is not based on per unit being produced, and definitely not semi-variable cost. Now the thing with supervisor is that a supervisor can supervise a certain number of people at a time. For example, 10 workers. One supervisor can supervise 10 workers. So the moment the worker count increases to 11 in the factory, you will have to hire an additional supervisor to monitor or to supervise the activity of 11 to, let's say, 20 workers. Then for the 21st one, again, you'll have to hire a new supervisor. So that looks like a stepped cost. So 21C. The following budgeted information is available. Production, total cost, production 30,000 and total cost is given. What are the fixed costs? So the shortcut to this question is you can get your variable cost per unit by taking the difference between the cost 326,400 minus 240,000, divide that by the difference in the production 12,000. So $7.2 is the variable cost per unit. Now let's say 20,000 unit is produced. So what will be the total variable cost? 20,000 into 7.2, 144,000. And if variable cost is 144,000, total cost is 240,000 as they've given it. How much would be the fixed cost? D, 96,000. Now this is the shortcut way of doing it. What you could do also is you can say let the variable cost per unit be X. So by that logic, for the first set of information for 20,000 units, what will be the total cost? Total cost will be, okay, total cost is given 240,000. So total cost will be equal to 20,000 X plus fixed cost. While for the second set of information, 326,400 will be equal to 32,000 X plus the fixed cost. So now you'll have to solve this algebraic equation in detail and calculate the value of X and the fixed cost. That will take a little more time, but you can remember this formula. Whenever total cost and the output is given for two different levels, you can calculate the variable cost per unit by using this formula, the difference in cost upon the difference in inventory or the output. Okay, 23. A business absorbs its overheads on the basis of direct labor hours. The following information is provided. Overheads are given, direct labor hours are given. By how much are overheads? Okay, they're given for actual and for budgeted. By how much are overheads under or over absorbed? First step is to calculate the overhead absorption rate, which is equal to budgeted overheads upon budgeted labor hours. So we get $30 per hour. The next step is to see how much is absorbed overheads, which is equal to actual hours multiplied by overhead absorption rate. Actual hours are 19,300 into 30. So 579,000, and then compare this to the actual overheads, which is given as 560,000. If absorbed is greater, it will be over absorbed. If absorbed is less, it will be under absorbed. So here it's the difference is 19,000 and it's over absorbed. So option C, 23C. Question 24. Which would be a suitable basis to apportion depreciation to production departments? Machine hours. Now, let's say the depreciation, the calculation is based on either straight line method or reducing balance method, which means either on the cost or on the net book value. So if I see machine hours, let's say a department has bought some machines, not used it. Since they did not use it, machine hours will not increase because of that, or they will not have the machine hours. But the depreciation has to be provided because there is a time factor involved, or because such assets like machine, they lose value. Even if you don't use them, they lose value. Let's say 1 year has passed and they will lose value. So for me, machine hours may not be a very suitable basis. So not sure about it. Net book value of the machine, as I told you, yes, this can be used because reducing balance method calculation is based on net book value of the machine. Whichever department has higher net book value, with more depreciation will be apportioned to that department. Number of machines. Again, this is not a very good way of apportioning depreciation. Why? Because let's say department A and B. Department A has just 2 machines, department B has 10 machines, but the overall value of the 2 machines is much greater than the overall value of 10 machines. In that case, obviously more depreciation should be apportioned to department A and less to department B. So this is again doubtful. I will not consider this a suitable method. Original cost of the machine, yes, that can be used. So the correct options would be 2 and 4 for me. Now we don't see 2 and 4 here. So I will see in which option do I have at least 2 and 4. I will see B and C. So either it could be machine hours along with these two, or it would be number of machines. Now between machine hours and number of machines, I think machine hours still is a better measure of how much depreciation should be apportioned, because more running of machines in any department is an evidence that more depreciation should be given to that. Though it's not the most suitable method, but yes, at least there's some logic to it. But number of machines, as I gave you the example, there's no logic to it. So 1, 2 and 4, option B would be the right one for me, 24B. The following information is available: selling price per unit, cost, variable cost per unit, budgeted break-even sales volume is 15,000, budgeted sales volume is 20,000. What were the fixed cost? So when break-even is achieved, fixed cost is equal to the contribution. So if we can calculate the contribution at the break-even level, we will get the fixed cost. 15,000 into contribution per unit is $6, 10 minus 4, 90,000. So 25D. 26. A business increased its profit by changing from marginal costing to absorption costing method. Which statement is correct? Now in marginal costing, the inventory is lower, and in absorption costing, the inventory is higher. Why? Because in absorption costing, you include the fixed cost also in the calculation of inventory, but in marginal costing, you don't include the fixed cost. Now, this means that both opening inventories and closing inventories, both their values will increase if you shift from marginal to absorption, because both opening and closing will be valued now at higher amount, including the fixed cost. But when they're saying that profit is increasing, it means that cost of sales is decreasing, then only profit will increase. And when will cost of sales decrease? When the closing stock increases by a higher amount compared to the opening stock. Then only the cost of sales will drop and the profits will increase. Why? Because cost of sales formula is opening stock plus purchases minus closing stock. So if closing stock increases by more than the opening stock, then only cost of sales will drop. And when will that happen? Now let's see the options. Production and sales were equal. No, this is not true. Production stopped in the period. Again, not true, because in that case, the closing inventory will be lower. Production was greater than sales. Yes, that makes sense. Closing stock in this case will be greater than the opening stock. Production was less than sales. Again, not the right option. So 26C. A company makes and sells a single product. Following budgeted information is available for 1 month. Selling price per unit, variable cost per unit, total monthly sales, total fixed cost. Directors are able to reduce the variable cost to $500 per unit. By how many units can budget sales reduce to achieve the same monthly profit? So currently, what's the profit? 750 minus 550, that's the contribution per unit. So $200. The total sales is 600 units. So profit will be equal to contribution minus fixed cost. Contribution is 200 into 600, 120,000. Fixed cost is 80,000. So 40,000 is the current profit being earned. So how many number of units should be sold to make the same profit? Units will be equal to fixed cost plus target profit divided by contribution per unit, revised contribution per unit. Fixed cost is 80 plus 40 divided by revised contribution per unit, 750 minus 500, so 250. So 480 units should be sold to make the same profit, which means by how many units can the budget sales be reduced? It can be reduced by 120 units, option A. There is an alternate way also of doing it. Instead of calculating the profit, you could also say that since they want the profit to be same and fixed cost is anyways not changing, they could assume that they want the contribution to be same. So what is the old contribution that they were making? 120,000. That also you could divide by the revised contribution per unit, which is 250, and you would get the same answer. But in case the fixed cost is changing, let's say they give you additional information that fixed cost is also changing, then you will have to follow this method. Question 28. Which assumption of cost volume profit analysis is not correct? Cost can be easily divided into variable and fixed. That's not the correct assumption, but okay. If you have a doubt, you can always put a mark. We'll come back to this statement. Total fixed costs remain the same. Yes, fixed costs don't change in cost volume profit analysis. Production is equal to sales. Yes, that is also one of the assumptions. Selling price is constant. Yes, variable cost per unit is also constant. That is also one of the assumptions. So B, C, D are all correct. Now let's go to statement A again. Costs can easily be divided into variable and fixed cost. No, because there may be semi-variable costs also in the business. And hence not all costs are always variable or only variable or only fixed. So there may be semi-variable costs also, and this is also not a valid assumption that we make when doing cost volume profit analysis. So 28A. 29. A business manufactures 4 products A, B, C, D. Information relating to these products are shown. In the coming month, labor hours are available for production are limited, and only one product can be produced out of these products. Okay, which product should be produced in order to generate the maximum profit? Selling price is given, contribution per unit is given, labor hour per unit is given, and overhead absorption rate is given. Now overhead absorption has nothing to do with marginal costing decisions, so we will ignore this. Now contribution per unit, as per contribution per unit, if you see, product A is highest profitable, so produce product A. But that is not the correct way of analyzing if one of the resources is limited. When the resource is limited, what you have to do is you have to calculate contribution per unit of that limited resource. So contribution per labor hour, this is what we have to calculate for every product. So how will you do that? Contribution divided by labor hours. 18 divided by 9, 2. 2 means for every 1 hour worked by labor, this product will help the business generate a contribution of $2. So $2 per labor hour. Same way for B it is 4. For C it is 6. For D it is 7.5. So clearly D, because contribution per labor hour is highest for product D. Why might a business use budgets to determine the level of demand for its product? Not really. To have a benchmark against which to assess actual performance? Yes, once the budgets are prepared and then the actual performance is there, you can compare and see whether overall the performance has been more than expected or less than expected. To know how much raw material suppliers will be able to supply, not really. Budgeting does not help you determine how much raw material suppliers will be able to supply. You'll have to make assumptions that raw material suppliers will supply this much. So 2 is the correct statement, 30D. So that completes paper number 11. Now let's start with paper number 12. Question number 1. A trader has prepared financial statements which include unpaid wages to her employees. Which accounting concept is being applied? Business entity? No, business entity is about differentiating between owner's transactions and business transactions. Duality, that is about every transaction having debit and credit effects. Matching? Yes, matching says that expenses should be recognized in the period to which they belong to, irrespective of their actual payment. So matching is the correct answer. And substance over form is not the right answer. It is not related to unpaid wages. On which basis will non-current assets be valued if the business is not a going concern? So going concern means that you assume that the business is going to continue forever or for a long time, for an indefinite time. If this assumption is not there, you cannot show your non-current assets at their net book value because you are not expecting the business to continue for long. So there is no expectations of the assets being used for a long time. In that case, what happens is the current value, the current fair value or the market value will be used as a valuation. So net book value, no. Cost, no. Amount they could be sold for, yes. That's called the fair value. And option D is value placed on them by the owner, no. So 2C. A business has a financial year end of 31st December. It depreciates its machinery on a month-by-month basis. It uses straight line method 10% per annum. It bought a machine costing 12,000 on 1st Jan 2019. Sold it on 31st March 2020. Which entries relating to this machine were made in the provision for depreciation account for the year ended 31st December 2020? Okay, so if you prepare the provision for depreciation account for 31st December 2020, on the credit side, you will have the annual depreciation for 3 months, and on the debit side, you will have to transfer the total depreciation till date for 2019 plus 2020. Now, what would be the depreciation for 2019? 10% of 12,000, which is 1,200. And for 2020, you're only going to take it for 3 months, Jan, Feb and March. So 300. So on the credit side, you will have 300. Debit side, you will have the total 2019 plus 20, 1500. So our correct option is option D. Fourth one, a business purchased a non-current asset for 500,000 with an expected life of 20 years. After that time, it was expected to be sold for 100,000. It was being depreciated using straight line method. The non-current asset was then sold after 10 years for 120,000 at selling cost of 10,000. It means the net selling price was 110,000. What is the loss on disposal? Okay, let's calculate the net book value. Before calculating the net book value, we will also have to calculate the annual depreciation, which will be cost 500,000 minus residual value 100,000. So 400,000 divided by 20. 20,000 will be the annual depreciation. So 10 years depreciation will be 20,000 into 10, 200,000. So the net book value at the time of selling would be 500 minus 200, 300,000. Comparing that to 110,000, there is a loss of 190,000. So 4D. Which items are capital expenditure? Payment of wages to staff to install new equipment. Yes. All incidental expenses relating to the purchase or manufacture or acquisition of any kind of capital asset of non-current asset will also be categorized as a capital expenditure. Purchase of new computer for office. Yes. Purchase of spare parts for factory equipment. No. This is like a repairs cost. So spare parts don't count as capital expenditure. Use of factory machinery to repair owner's car. No, this is not a capital expenditure. So 1 and 2, 5A. A sales ledger control account shows a debit balance of 15,000. The following errors were then discovered. Return outwards $200 has been credited in the sales ledger control account. Now return outwards is purchase returns. It should not appear in the sales ledger control account, but they've put it on the credit side. Contra entry, $400 had been debited in the sales ledger control account, but contra entry should be shown on the credit side. Customer balance $300 had been written off in the sales ledger control account, but no entry has been made in the sales ledger. It means in the customer's account the entry is not made. Which figure for trade receivables should appear in the statement of financial position? So if we calculate the correct balance as per sales ledger control account, we will get the answer. So brought down is 15,000. The purchase returns that we credited, we will have to reverse it by debiting it back here. Contra entry should have been credited, but it is debited, so double we will be crediting 800. The last one does not get corrected in the control account, so final balance carried down would be 14,400, so 6A. Had they given the balance as per sales ledger, so balance as per sales ledger, had they given that, I would have taken that and adjusted this error number 3 to arrive at the same answer, 14,400. But since they've not given that, so the only way to do is this, preparing the corrected control account. The bank account had a debit balance of 5760 in cash book at 31st May. The following items were identified when reconciling the bank account with bank statement. Amount not yet credited by bank, uncredited deposits, in other words $900. Bank charges 120, dishonored check 340, unpresent check 740. What was the amount shown in the bank statement? First, prepare the updated cash book. That starts with the debit side balance brought down 5760. Bank charges 120, dishonored check 340. So the revised balance carried down would be 5760 minus 460, 5,300. Then prepare the bank reconciliation statement. Starts with the updated cash book balance. To this you add the unpresented check 740, subtract the uncredited deposits 900. So 5140, 7B. Question 8. A trader maintains a full set of accounting records. Each month she issues many sales invoices. Where does she record an individual sales invoice? When a sales invoice is issued, it is entered in the sales journal or the sales day book. Part A or option A, sales journal and the sales ledger. From the sales journal, let's say you enter the various sales invoices are issued to debtors ABC. From there it goes to the individual debtors account, and these debtor accounts are maintained in the sales ledger. So this looks like the correct option. Anyway, let's read all the options. Sales journal and sales ledger control account. This is not the correct option because sales ledger control account is not a part of the double entry bookkeeping. It is a separate process that is done with a different purpose, with a different motive. So this is not the correct option. Sales ledger and sales account. This is not true. Individual sales invoices are not entered in the sales account. You prepare the sales journal and then you take the total at the end of the period and then transfer that total to the sales account. So the question is about where does she record individual sales invoices. Hence option C is not correct. Option D also contains control account, so not correct. So option A. Brian had a service business which held no inventory. His current assets and current liabilities on 1st April were as follows. On that date, he set off a sales ledger balance $600 against a purchase ledger balance and then created a provision for doubtful debts of 5%. What was the value of his working capital? Working capital is current assets minus current liabilities. So if we get the current assets and the current liabilities, we will be able to calculate the working capital. Current assets would be trade receivables, but from this trade receivables, we will have to subtract the set off or the contra. And on the remaining, we will have to apply 5% doubtful debts. So 95% we will calculate. So 9,400 into 95%, 8930. And current liabilities will be trade payable 6,100, but from this we'll have to set off 600 and plus bank overdraft of 1900. So 6,100 minus 600 plus 1900, 7,400. So the working capital will be 8930 minus 7400, option C. 10. FREDA's provision for doubtful debts account for the year included a debit entry representing the change in the amount provided. The rate of provision for doubtful debts has not changed. So what do they tell you, or what are they trying to tell you is, this is the provision for doubtful debts account. You have a balance brought down, you have a balance carried down. There could be one more, there is always one more entry to either increase the doubtful debts balance or to decrease the doubtful debts balance. If it is on the credit side entry, that means you are increasing the doubtful debts balance. If the entry is on the debit side, it means you're decreasing the doubtful debts balance. For this question, they're telling you that there is an entry on the debit side. So this is important. What might have happened during the year? Credit control procedures had been improved. Possibly this could be the correct option, because what this statement means is, now you're able to collect debts from the customers in a better way, faster, and better credit control procedures are there in place. So less chances of bad debts and provision, hence lower requirement of provision for doubtful debts. And once there is a lower requirement for provision for doubtful debts, the entry will be on the debit side of doubtful debts account. So this could be the correct option. Let's read the other statements also. Credit control procedures have been reduced. This is not the correct option. It's exactly opposite of 1. Total trade receivables had decreased. Possibly yes, because then you would need a lower doubtful debts balance. Total trade receivables had increased. No, because if the rate is same and if the debtors balance had increased, the provision for doubtful debts balance would have increased at the closing compared to the opening. So 1 and 3 could have happened. So option A, 10A. Question number 11. A trader's income statement recorded sales 10,000 and cost of sales 7,070. Trader had taken goods for his own use during the year 280 and selling price was 410, but had omitted to record this. What effect does this omission have on the gross margin? Let's calculate the gross margin first before adjusting this stock drawings. So gross margin formula is gross profit upon sales into 100. So 10,000 minus 7,070, 2,930 divided by 10,000 into 100, 29.3%. And if we calculate the revised gross profit margin, for that we'll need the revised gross profit. So if we take into account this 280, cost of sales will reduce by 280 and gross profit will increase by 280. So 3210 divided by 10,000 into 100, 32.1%. So question is, what effect did this omission have on the gross margin? So because of this omission, what happened? Compared to the actual gross margin, the current gross margin is understated by 2.8%. So option B. William buys radios for $10 and sells them for $15 each. His draft statement of financial position included a value of $1,500 for inventory. His method of calculation of inventory was correct, which means he used cost. He then found out that 12 radios could only be sold for $8 and 4 radios had been stolen. By how much should William reduce his inventory valuation? Ignoring this last statement, if he values inventory at $10 and they are saying that 1,500 is the value of inventory, it means the quantity of radios available in stock is $150 units, and this would have been multiplied by $10 to arrive at 1,500. Now they are telling you that out of this 150, 4 are stolen, 12 are damaged, and the balance radio units, which would be 134, are in good condition. So now let's calculate the correct value of inventory. The 4 units that are stolen, that will have 0 value. The damaged units of radios will be now valued at either cost or NRV, whichever is lower. Cost is $10, NRV is $8. So these 12 units will be valued at $8 per unit. So that gives us $96. And the remaining 134 units, that you will continue valuing at $10 per unit. So 1340. So the total value of inventory as per the correct valuation would be 1436. Comparing this to 1500, it means value is excess by $64. So question is, by how much should William reduce his inventory valuation? 64, option A. A sole trader has not kept a full set of double entry records. The following information relates to the business for the year ended 31st March 2021. Sales, inventory, this is opening, then this is closing. Prepaid expenses at the opening are given. Expenses paid by check are given. All goods are marked up by 25%. What were the purchases and the profit? If the sales is given as 210,000 and markup is given 25%, how can we use it? So what we can do is we can say let the cost of sales be 100. If the markup is 25%, so for cost of sales 100, our gross profit would be 25, and eventually our sales comparatively would be 125. So based on the current data, if sales is 210, can we get our cost of sales? Yes, cost of sales would be, okay, you can write it here for easy understanding. In the current context, sales is given as 210 and we are trying to calculate the cost of sales. So we are going to cross multiply. Cost of sales is equal to $210 divided by 125 into 100. 168,000. So that makes the gross profit equal to 210 minus 168, 42,000. But we need the purchases. Okay, using the cost of sales, we can calculate the purchases because opening and closing inventory is given. So purchases will be equal to cost of sales plus closing inventory minus opening inventory. 168,000 plus 18,700 minus 17,600, 169,100. So our correct option should be D because purchases is 169,100 for option D. But let's calculate the profit for the year also. Given the gross profit and given the expenses, we can calculate the net profit. So net profit will be equal to 42,000 gross profit minus the expenses, 11,900 paid by check, and opening prepaid will also be added to the expenses of this year. So 42,000 minus 12,530, 29,470, and if you look at option D, yes, 29,470 is correct. So 13D. Which statement is correct in the absence of a partnership agreement? Interest is charged on drawings at 5%, which is not correct. 0% for interest on drawings. Only one partner can have a salary, not correct. No partners have salary. Partners are not entitled to interest on capital. This is the correct statement. Profits are shared in the ratio of partners' contribution, capital contribution, not correct. They are shared equally. So 14C. X and Y are in partnership sharing profits and losses equally. They have combined capital account balance of 200,000. Z was admitted as a partner. Non-current assets were revalued upwards by 30,000. Goodwill was valued at 20,000. But was not to be retained in the books. Following Z's admission, the total of the partner's capital account was 270,000. How much did Z contribute? Now you can solve this by either preparing the capital account. Okay, let's prepare the capital account. There's another shortcut also that you can use, but that might be a little confusing, so better prepare the capital account. Okay, since both the partners are given together, they have not given individual capital accounts, we'll prepare one single column for both the partners, X and Y. So brought down 200,000 and non-current assets were revalued by 30,000. So on the credit side, they would have credit of 30,000, both the partners together. Goodwill was valued at 20,000. So both the partners will get credit in their goodwill account. Okay, on the debit side, we'll have X and Y and partner Z. Goodwill will be written off in the new profit sharing ratio, which is not given in the question. So we assume that it is equal between all three partners. So X and Y together would get 2/3 of 20,000, which would be 13,333. For simplicity, what I'm going to do, I'm just going to write 13,000 and 7,000. And what they want is that the additional capital invested by Z as a partner that they want, that is not given. Now let's calculate the closing balance of X and Y. So 200 plus 30 plus 20, 250, 250 minus 13, 237 is the closing balance for X and Y. They're telling you that the total closing balance for X, Y and Z together is 270, which means that the closing balance of Z has to be 33. If Z's closing balance is 33 and on the debit side there's already a 7, what entry on the credit side for this bank would make the account of Z balanced? 40,000. So 15B 40,000. I was telling you that there's a shortcut to do it. What is the shortcut? See, old balance of the partner's capital is 200,000. They will revalue their account, so they will get a credit of 30,000. So after revaluation, their total capital is 230. Why am I not taking goodwill? Because goodwill is an adjustment of amount between partners' capital, the old and the new partners. So if you add it to one of the partners, basically you're taking it from the other partner, from the new partner, and putting it in the old partner's capital account. In total, the partner's capital don't change because of goodwill. So I'm ignoring goodwill, and the new capital after Z's admission is 270, they're telling you. So what is the change in capital? 40. This is the easy way of understanding, but if this is confusing, you can prepare the partner's capital. A company's statement of financial position at 1st Jan 2020 included the following: ordinary share capital, general reserve, retained earnings. Following transactions took place. So all these are opening balances. Company issued a further 50,000 ordinary shares at a premium of $1. Company's land was revalued upward by 130,000, and the company paid a final dividend of 60,000. What were the total revenue reserves and capital reserves? Okay, the revenue reserves would be general reserve and the retained earnings. So opening is 200,000. To this, profit should be added, but the annual profit is not given in this case. Dividend is given, so you'll subtract dividend. So 140 is the retained earnings after the transactions. What about capital reserve? In the capital reserve, you will have share premium and you will have revaluation reserve. How much is the share premium? 50,000 into $1. So share premium is going to be 50,000. Revaluation reserve is going to be 130. So total capital reserve is going to be 180. So the option that matches our amounts are option A, 16A. A company revalued its premises upwards. Which statement about the increase in value is correct? It is an unrealized profit, which is correct. It is debited to revaluation reserve. No. It is credited to revaluation reserve. It is recorded in the income statement. No. It is not transferred to income statement. It can be used to pay cash dividends. Again, no. So 17A. Question 18. The table shows equity and liabilities of a company: ordinary share capital, 6% debentures, bank loan, bank overdraft, and mortgage on building. Mortgage means it's a loan taken for the building. Repayable in 2021. This is important. If currently we are at 31st December 2020 and the amount is repayable in 2021, this becomes a current liability, even though it's a long-term loan, but as of now it's a current liability. What is the total of non-current liabilities? So debentures and the bank loan that is repayable in 2024, 225,000. Overdraft is a current liability. Mortgage on building, I would have taken as non-current liability if this was 2022 or above. So 18B. The non-current asset turnover of a business improved between 2020 and 2021, even though the net revenue was same for both the years. Okay, let's write down the formula for non-current asset turnover: revenue upon non-current assets. They are telling you that the revenue in both the years was same. Now, what caused the improvement in the ratio? See, the only way this ratio can improve if revenue is same, if the non-current assets go down in value. A reduction in level of irrecoverable debts, no relevance here. It's not used anywhere in the calculation. Upward revaluation of premises. If this was the case, non-current assets would have reduced or would have not improved. It would have gone down. so not the correct option. Depreciation charged being higher than the cost of new non-current assets looks like correct, because higher depreciation than cost will lead to lower net book value of non-current assets, and eventually the ratio will improve. Purchase of new non-current assets being greater than disposals, no. If this was the case, then the ratio would have been lower in 2021. So 19C. A business provides the following information: trade payables, opening and closing inventories, credit purchases, credit sales. What is the trade payable turnover? The formula is average trade payables upon credit purchases multiplied by 365. What is the average trade payables? 39,540. Credit purchases 184,600 into 365. So 78.18, we can call, or we can say that it's 79 days. 20C. When a company produces 5,000 units of a product, it requires one supervisor. If the production is increased beyond 5,000, then two supervisors required. What type of cost is this an example of? Stepped cost. It is not fixed cost, because if this was fixed cost, then for all units there would be just one supervisor and it would be fixed cost. Semi-variable, if the salary of the supervisor was linked with the output, then we would call it either variable or some kind of semi-variable, but none of them. Stepped cost, because for first 5,000 it is fixed, then the moment it increases beyond 5,000, for the next 5,000 again it increases and remains fixed. So this is an example of stepped cost. A business employs 20 workers as production staff. Each worker is employed for 40 hours per week at a rate of $7.8. Bonus is calculated at 20% of the basic rate pay per hour for each product manufactured above 120 units per employee. In a week, each employee produced 145 units. What are the total wages for the week? So let's calculate the basic wages first. Basic wages will be 20 workers into 40. Okay. What we can do is we can multiply with 20 workers at the end, basic plus bonus, and then we'll multiply by 20 workers to make our calculations easy. So 40 hours into 7.8, $312. That's the basic wage of every employee. Bonus. For bonus, you'll have to see how much extra output is produced. Based on the extra output produced, the management will give the workers bonus. Extra output over and above the target is 25. 145 minus 20. 25 units produced. Now these are in units. What I'll do is I will convert this into the hours saved, time saved by the management because of these extra units. For 40 hours, the target is 120, which means in every 1 hour, the management expects them to produce 3 units. So for 25 units, the time expected would be 25 divided by 3 units per hour. This will be in hours, and then I will multiply it with the wage rate or the bonus rate per hour. Bonus rate would be 20% of the basic. Basic is 7.8. 20% of that is 1.56. So when we calculate 25 divided by 3 into 1.56, $13 is the bonus. So total per employee is going to be 312 plus 13, 325. This will have to be multiplied with 20 employees. 6,500 is the total wages. Our option is clearly not here. Now I'll tell you what is done in the marking scheme and how is it done, how it could have been done. Probably it's just a guess. As per the marking scheme, the correct option is option A. What they have done differently is that they have not considered this divide by 3. So basically, they did 25 units, which is the extra output, multiplied by $1.56. In other words, what they are assuming is this 1.56, that 20% of 7.8, they are assuming this to be in terms of per unit. So when you do this, 25 into 1.56, $39. Now the total will be 312 plus 39. 351. This when multiplied by 20 you get 7020. That gives you option A. Now the question is this the correct way of doing it? According to me, no, because they are telling you that the bonus is supposed to be 20% of the basic pay rate per hour. How can you multiply something that is in per hour? You multiply that by 20%, you get 1.56. How can you convert it into per unit? That is not the right way of doing it. If the bonus is if the basic is in per hour, you promise the employees that you will be paying 20% of the bonus, 20% of the basic as bonus, which is 1.56. That also has to be in per hour. So the multiplication of 25 into 1.56 directly, this I don't understand, but this is what has been done in the marking scheme. That's what I understand. If you understand the answer better, if you think it is correct, if you have a valid reason, yes, you can always comment below. I will reply and I will also pin that comment so that everyone can read it and understand. Question 23. A business uses absorption costing to set its selling prices. Which overheads are accounted for by the use of overhead absorption rate? Which, in other words, they're trying to ask you is, when you calculate the overhead absorption rate and in the formula is the budgeted overheads upon the, let's say, labor hours or machine hours, whatever. Question is, what are these overheads? Are these production overheads, admin and selling, all three together? Or they are only production? They are variable production, admin and selling, variable production only. See, this overhead absorption rate is always calculated for the cost centers that are there in the factory. So one thing is very clear, that anything outside the factory or any overhead outside the factory will definitely not be taken into account while calculating the overhead absorption rate. So whichever option has admin and selling, that will definitely not be correct. In other words, overhead absorption rate is always calculated for production overheads. Now another question, is it for fixed overheads, is it for variable overheads, or is it for both? It is for total production overheads, variable and fixed both. So 23B. 24. A business uses absorption costing and applies a markup of 50% when setting selling prices. Basically, when they get the cost, they add on 50%. Each unit of product at X has a direct cost of 60, selling price of 150, and requires 2 hours of machine time. What is the overhead absorption rate? If the selling price is 150, what should be the cost? To which, when you add on the 50% markup, will give you selling price of 150. So 150 divided by 150 into 100. In other words, cost is $100. If the total cost is $100 and direct cost is $60, how much is the overhead cost? $40. If overhead cost is $40 and the time taken in machine is 2 hours, how much is the overhead absorption rate that they are applying? $20 per hour, which is option C, 24C. Because when absorbing overheads, your formula is absorbed overheads will be equal to time multiplied by overhead absorption rate. So here you have $40 as absorbed overheads is equal to 2 multiplied by overhead absorption rate. So that's why $20 per hour. 25. A business had no opening inventory. In 1 month, it produced 4,000 units and sold 3,500 units. Following information is available. Selling price is given, variable cost is given, fixed cost per unit is given. How would inventory value and profit vary between absorption costing and marginal costing? Now, between absorption costing and marginal costing, the inventory value is the only value that is different. So our inventory as per absorption costing will include the variable cost and the fixed cost both. Which, in other words, as per absorption costing, inventory value is going to be 500 units. Why 500? Because production is 4,000, sales is 3,500. So 500 into total of 30 and 15, so $45 per unit. 22,500. Inventory as per marginal costing, you're going to only value it at the variable cost, which so 500 into 30, 15,000. In other words, inventory value in absorption costing is higher by $7,500. So it's either option A or option B. Now, when inventory is higher in absorption costing by $7,500, cost of sales will reduce by that amount and profit will be higher by $7,500. So profit is higher by $7,500 and hence option A. Question 26. Which costs are part of the marginal cost of a product? Marginal cost means variable cost. Direct material, yes, it's a marginal cost. Fixed production, fixed selling, no. Variable production cost, yes. So 1 and 4, which is option B. A company provided the following information: variable cost, contribution, fixed production cost, fixed selling and distribution. What is its budgeted break-even sales revenue? At break-even, basically the contribution will be equal to the fixed cost. Then only you get profit equals to 0. Fixed cost is 420,000. In other words, at break-even, contribution is going to be 420,000. Now that's one part of the question. Apart from this, we also need the contribution to sales ratio of this product. If contribution is 360,000 when variable cost is 540,000, so for this combination the sales is going to be 900,000. So how much is contribution to sales ratio? 360,000 divided by 900,000 into 100, 40%. Now in the case where the company is making break even, contribution has to be 420,000. So our sales is going to be 420,000 divided by contribution to sales ratio of 40%. 1,050,000. So option D. Question 28. Details of two products made by a company were as follows. Selling price is given, variable cost is given for both these products. Company could sell maximum of 11 for X and 9,000 for Y, but the company cannot produce more than 10,000 units together for both these products. So for this question, we will have to calculate first the contribution per unit, which is $2 and $4 for X and Y. Normally in limiting factor questions, whatever is the limited resource, we try to calculate the contribution per unit of that limited resource. But in this case, the output itself is the limiting factor. So we will be comparing, or we will be giving ranking based on the contribution per unit itself. So Y gets the first rank and X gets the second rank. So they will first use all the resources to produce Y, but the maximum demand for product Y is 9,000. So they can't produce 10,000 of Y. So they'll produce only 9,000 of Y. Then they will use the remaining resources to produce 1,000 of X. So yeah, that's the question. What combination will they produce? Which is 1,000 X and 9,000 Y, option B. 29. A manufacturer has a target profit of 80,000 per annum. Last year, the business made a profit of 60,000 when 10,000 units were produced and sold. Contribution was $10 per unit. Okay, what can we calculate from this given information? When 10,000 units were produced, profit was 60,000, which means profit was $6 per unit. Contribution is $10 per unit. In other words, the fixed cost is $4 per unit. But I'm not interested in per unit. I'm interested in total fixed cost, which is into 10,000 units. 40,000 is the total fixed cost of the business. In order to achieve the target profit, the plan is to increase the advertising cost by 10,000. Variable cost per unit and selling price per unit will remain same. In other words, contribution per unit will remain same. What will be the total fixed cost if the plan is carried out? Very simple. 40,000 plus 10,000. Old fixed cost plus new fixed cost. 50,000. 29D. Which are advantages of a budgetary control system? So budgets help to prepare year-end financial statements. Not really. They are only based on estimates. So you can only try to predict what might be the performance of the firm in future. But actual income statement and actual balance sheet, they don't help you to prepare that. Budgets may be set at easily achievable levels to make the business appear more efficient. Not really. If you achieve easy targets, or if you keep easy targets in the budgets, it will lead to inefficiency, underperformance by the employees. They will not give their best. Managers become responsible for implementing their department's budget. Yes, when you hand over the budget to the managers, they are made responsible. They are at the same time, they're also given the necessary resources, and they are made responsible to achieve the departmental performance as per the budget. When budget targets are not met, corrective action is taken. Yes, at the end of the year, end of the period, you can compare the actual performance with the budgeted performance, and wherever required, corrective action is taken. So 3 and 4, 30D. So that completes paper number 12. Now let's start with paper number 13. Question number 1. A company does not include in the financial statements the value of skills gained by its employees from training programs. Which accounting concept is being applied? Basically, the non-monetary transactions are not recorded. That's what they're trying to tell you. So this principle is followed under money measurement. 1C. Question number 2. The following transactions took place: owner's withdrawal of inventory for private use, purchase of new shop fixtures on credit, writing of an irrecoverable debt. Which transactions would be recorded in the general journal? The first one, yes. The purchase of new shop fixtures on credit, yes. Writing of an irrecoverable debt, yes. So 1, 2 and 3, 2A. Now just to quickly explain, what do you mean by general journal? So the books of prime entries are divided into the sales day book, the purchase day book, the sales returns day book, purchase returns day book, cash book, petty cash book, and finally the general journal. The sales day book would record credit sales of goods, purchase day book would record credit purchases of goods, sales returns and purchase returns books would always record the relevant transactions, cash book would record all cash and bank entries, petty cash book would record all petty cash transactions, and all other transactions are recorded in the general journal. So this or these three statements here, these three transactions, they can't be recorded in any of these books, and hence they are recorded in the general journal. Question number 3. The accounting year end of a company is 31st December. The company purchased a motor vehicle on 1st Jan 2020 and incurred the following cost. 30,000 was the cost, out of which half was paid by check, the balance was paid by bank loan. Loan interest for the year ended 31st December 2020 was 2,500. Delivery cost, engine improvement cost, and repair and maintenance cost for 3 years. Motor vehicle was to be depreciated by 20% per annum using straight line method. What is the depreciation charge for the year 31st December 2020? So first we will have to calculate the total cost, which is 30,000 plus the interest. We will not include in the capital expenditure in the cost, it's a revenue expenditure. The delivery cost 2,000 and engine improvement cost 4,000, so 36,000. Depreciation is 20%, so multiplied by 20%. Full year, so 7,200, so 3B. Question number 4. A business sold a non-current asset. It had been purchased for 15,000 and had an estimated life of 10 years with no residual value. It was depreciated using straight line method. It was sold after 6 years. Disposal cost was 1,000. Profit was 3,000. Was the sale price? First calculate the net book value, which will be cost 15,000 minus annual depreciation would be 15,000 divided by 10, 1,500, depreciated for 6 years. So 1,500 into 6, 9,000 will be the total depreciation till date. So 6,000 will be the net book value. Now disposal cost were 1,000. Okay, let's keep that aside. Profit on disposal is 3,000. So how much would be the sale value? The sale value will obviously be 9,000, 6,000 plus 3,000. By sale value, I mean net sale value, which is after the disposal cost. To this, if we add the disposal cost 1,000, we will arrive at the gross sale price, which is 10,000. So 4C. Question number 5. Which statements about a depreciation charge for the year are correct? It is a non-monetary expense. Correct. It is debited to the provision for depreciation account. Wrong. It is credited to the provision account. It is only provided on non-current assets with an estimated useful life. Correct. Because assets like, let's say, land that does not have a limited life, it has an indefinite life, that those assets cannot be depreciated or will not be depreciated. Only assets with limited life will be depreciated. So 1 and 3, 5B. The sales ledger control account of a business showed a debit balance of 26,400. This did not agree with the total of sales ledger balances. Following items appeared in the sales ledger accounts but had been omitted from the control account: contra, discount allowed, dishonored check, and irrecoverable debt of 438. What is the correct balance on the sales ledger control account? So start with 26,400, subtract 340, subtract 56, add back the dishonored check, and subtract the irrecoverable debt. So we get 25,628, 6B. Question number 7. Which are the reasons for preparing a trial balance? To assist in preparing draft financial statements. Yes, that's true. After trial balance only you can go ahead and prepare the financial statements. To detect all errors in the books of accounts. Not really. Trial balance does not help you to detect the errors. It does not tell you where the error is in the books of accounts. It will only tell you whether arithmetically the books are free from errors or no. To find out the balance of suspense account? Not really, because the purpose of preparing trial balance is not to find out the balance of suspense account. Yes, if the trial balance does not match, we put the difference in the suspense account. So some of you might have a doubt in this statement, but ideally if you see as per theory, the two purposes of preparing a trial balance are: first, to prepare draft financial statements, and second, to check the arithmetical accuracy of the ledgers. That's it. So out of this, only first one looks absolutely correct. Third one we have a doubt. Now let's look at the options. So it could be either A or B, because only these two options have number 1 in them. But since 2 is clearly not correct, so for us it becomes 7B. Question number 8. The following information is available for telephone account for the year ended 31st December at 31st December. So opening and closing, and payments and refunds are also given. What was the telephone expense? So you start with the payments, 19,000. So you take this. Then opening accruals you will subtract. Closing accruals you will add. Opening prepayments you will add. Closing prepayments you will subtract. And the refund you will subtract. So 20 minus 5, 19,508C. You could also prepare a telephone account, put the amounts on the correct side, and then on the credit side you will have the income statement value. That is the correct answer. Question 9. A trader calculated his draft profit for the year 16,000. The following items had not been adjusted. A decrease in prepaid insurance, which means opening is greater than the closing for prepaid insurance. That's why they're telling you it's a decrease. So opening prepaid insurance is usually added to the expense and closing is subtracted. So since opening is greater than closing, so there will be a net increase in the expense of $400. Increase in closing inventory, which means the closing inventory is greater than the opening inventory. Decrease in provision for doubtful debts, which means this is an income. Increase in accrued rent receivable. Again, this will increase the income. So what was the profit for the year after adjusting these? So when you decrease the prepaid insurance, the 400 plus that we discussed here, this is a plus in the expenses. So profit will decrease. So 16,000 minus 400. The increase in closing inventory will be added, because the closing inventory, as it increases, the profit increases. Provision for doubtful debts, when decreased, profit will increase, and increase in accrued rent receivable will also increase the profit. So 9C, 17,220. An item of capital expenditure has been incorrectly treated as a revenue expenditure in the financial statements of a business. What is the effect of this error on the financial statements? The assets will be understated, because a non-current asset is treated as an expense, and profit for the year will be again understated because of higher expenses. So 10D. Question number 11. The following information is available for a business at the start of the year: non-current assets, and current liabilities, and then the transactions for the year, drawings and profit. What is the closing capital for the year? So we start by calculating first the opening capital. Opening capital will be non-current assets plus current assets minus the current liabilities. So let's calculate that. 51,500. To this we will add the profit 6950 and subtract the drawings 5,000. So 53,250. But our option is not here. Let me double check the calculations. Okay, this is 51,500. So yeah, 53,450. So 11B. A trader did not keep full accounting records. The following information was available for 2020. Opening, closing, trade payables, payments, discounts received. What is the value of purchases? So you start with the payments, 72,830. To this you add the closing trade payables, 43,630. You add the discount received, 3,450, and you subtract the opening, 32,785. So 87,125, 12D. Question number 13. How would the following transactions affect the owner's equity, which means capital, of a sole trader? Paying the owner's personal motoring cost from the business bank account. This is the drawings. This will decrease the owner's equity. Taking a long-term loan to finance the purchase of new business machinery. This does not affect the owner's equity in any way. So 13A. Question 14. A partner is retiring from a partnership business. What is the correct accounting treatment for goodwill if no goodwill is to be retained in the books? The old partners, which means all the partners, they will be credited in the old profit sharing ratio. So we have it here and we have it here. And in the new partners, which is the continuing partners, you will debit goodwill in the new profit sharing ratio, which is here. So 14A. Question number 15. X, Y and Z are in partnership sharing profits and losses equally. At 31st December 2020, X had a capital account balance of 100,000 and a current account credit balance of 80,000. On 1st Jan 2021, X retired. Non-current assets and goodwill were revalued upwards by a total of 60,000. X left half the amount due to her on retirement as a loan to the partnership. The balance was paid to her by check. How much was X paid? So if you could find out how much was the total amount due to X at retirement, we'll take half of that and that will be the answer. First of all, the capital balance is 100,000. The current balance is 80,000 and next day itself X retired. So 180 and plus non-current assets and goodwill both were revalued. So X will get his or her share in this 60,000 upward revaluation of non-current assets and goodwill. So 1/3 of 60,000. So revaluation and goodwill 20,000. Total 200,000. So half of this 100,000. So 15C. A company had a share capital of 100,000 ordinary shares of $1 each at the start of its financial year. Following transactions took place. An issue of 50,000 ordinary shares at $1.4 each was made. So $1 face value, 0.4 is share premium. Bonus issue of 15,000 ordinary shares of $1 each was then made. 12% debentures was issued. Bank loan 75,000 was repaid. What was the net cash inflow? Because of these transactions, bonus issue wouldn't affect the cash flow. The debenture issue, $100,000, this will be plus because it's an inflow, and bank loan 75,000 was repaid. This is an outflow, so minus. Now, ordinary shares 50,000 into $1.4, total amount received was plus 70,000. So net cash flow or net cash inflow would be 70 plus 100,000, 170 minus 75, 95,000, 16B. Question number 17. A company paid an ordinary share dividend of 15,000 in the year. Where would it appear in the financial statements? Payment of dividend always appears in the statement of changes to equity. So as a finance cost in the income statement, no. As an admin expense, definitely no. Under retained earnings in the statement of changes to equity, yes. Under share capital, definitely no. So 17C. The equity of a limited company is shown start and end, ordinary shares, retained earnings, total. During the year, the following transactions took place. A bonus issue of 1 for every 4 was made. Debenture interest was paid. Interim dividend was paid. What was the profit for the year? So to calculate the profit for the year, what we can do is we can prepare the retained earnings column of the statement of changes to equity. We start with the opening balance 77,000. At the end, we will write the closing balance 112,000. What would be the transactions that would appear during the year? We would have profit, which we don't know. We need to calculate this. Then bonus issue was made, 1 for every 4. At the start of the year, 200,000. So 1/4 of that, 50,000. So bonus issue minus 50. And interim dividend, 22,000 was paid. So minus 22. Debenture interest doesn't appear in the retained earnings section. So now we just need to calculate profit as the balancing figure. So we could start with 112,000 plus 50 plus 22 minus 77. 107,000 will be the profit for the year. 18B. The following information is available: sales, purchase, average inventory, markup. What is the rate of inventory turnover? The formula is cost of sales upon average inventory. Average inventory is directly given. Cost of sales we need to calculate. Now markup is 25%. Sales is given. So how will we calculate the cost of sales? Cost of sales will be equal to 250,000 divided by 125 into 100. So 200,000 is the cost of sales. So in this formula, cost of sales 200,000 divided by average inventory 20,000, 10 times. I am assuming you know how to apply the ratios, markup and the margin on sales and cost of sales to arrive at this number. If not, you can watch my video on this topic. The trade receivables turnover of a business has been calculated for 2 years. Okay. This year is 60 days, last year was 50 days, so collection is delayed by 10 days basically. What is the possible reason for the change? Increased level of discounts received. Discount received has nothing to do with trade receivables turnover, so definitely no. Increased profit margins, no connection as such about between profit margins and the delay in collection, so doubtful. Increased cash sales volume, not really. If cash sales would increase, then collection should be sooner. Customer liquidity problems, yes, and that is why the customer is delaying payments, so 20D. A manufacturing company employs 20 workers who are paid at the basic rate of $30 per hour for 40-hour week. To meet a special order, workers each worked 50 hours and were paid a premium of 40% over the basic rate. What was the value of wages paid to meet the special order? So first they were paid 20 workers into 40 hours into $30. So 24,000 is the basic. On top of that, they were also paid the bonus. They worked 10 hours extra. So 20 workers into 10 hours into 40% premium. So $30 per hour plus 40% of that 12. So 42. So we have 8,400 as the bonus. So total 32,421B. A company paid the following telephone cost: number of customer inquiries, total cost for month 1 and month 2. Telephone costs are a semi-variable cost. What would be the total telephone cost for 305,000 inquiries? When such a situation is given, basically semi-variable costs are given at 2 levels of output or at any unit. You can calculate the variable cost per unit, in this case per inquiry, as the difference in cost, difference in total cost upon difference in output. In this case it's difference in inquiries. Difference in cost 575 minus 425, 150,000. Difference in inquiries 350 minus 250, 100,000. So per inquiry it cost $1.5. This is variable cost per unit. Now we can also calculate the fixed cost. Fixed cost, let's say we assume 250,000 inquiries have happened. The total cost is 425,000. So from this, what we are going to do, we are going to subtract the variable cost, which will be 250,000 into 1.5. So which is 375. So 425 minus 375, 50,000 is the fixed cost. Now at 305,000, so for 305,000, the total cost will be fixed cost plus variable cost, which is 50,000 plus 305,000 into 1.5. So 507,500, which is 22B. Question 23. Which statements are correct? When output increases, fixed cost per unit decreases. Correct. Fixed cost per unit means fixed cost upon output. So if output increases, the overall number will decrease. When output increases, variable cost per unit stays the same. Yes, variable cost per unit is supposed to remain same at every level of output. When output decreases, total fixed cost stays the same. Yes, total fixed cost is supposed to remain the same at every level of output. When output decreases, total variable cost decreases. That's true, because variable cost is completely related to the output. Output decreases, variable cost decreases. So 23A, all four statements are correct. A company's fixed overhead details were as follows: budgeted, actual, hours are given, fixed overheads are given. What was the over or under absorption of fixed overheads? First calculate the overhead absorption rate, which is budgeted overheads upon budgeted hours. So $15 per hour. Then calculate the absorbed overheads, which will be actual hours 11,000 multiplied by 15. So 165,000 will be absorbed, and then compare it with actual overheads, which is 170,000. So here you see absorbed is less, so it becomes under absorbed 5,000, 24B. Question 25. The following budgeted data is available for July 2021. Direct labor $80,000 paid at the rate of $20 per hour. Indirect labor, factory expenses, depreciation on machine, depreciation on office equipment, admin expenses. What is the budgeted overhead absorption rate per direct labor hour? So in other words, they are asking you the overhead absorption rate, which will be the total budgeted overheads upon total hours. Now out of these, what will be the overheads that will be considered? Direct labor is not an overhead. Indirect labor, yes. Factory expenses, yes. Depreciation on machine, yes. Depreciation on office equipment and admin expenses, these are not related to factory, so these are not considered. So 78,000 in the numerator, and divided by the total labor hours. $80,000 is paid when the wage rate is $12.20 per hour. So that makes the total hours equal to 4,000. So 78,000 divided by 4,000, $19.525A. 26. The following budget information is available for a business: revenue, variable cost, fixed non-production cost, fixed selling and distribution cost. What is its budgeted break-even sales revenue? So we will have to calculate the break-even revenue, and the formula for that is the total fixed cost divided by contribution to sales ratio. Fixed cost would be 150 plus 90, 240,000. And what would be the contribution to sales ratio? You'll have to calculate that separately. Contribution to sales ratio will be revenue minus variable cost will give you contribution in the numerator. So 260,000 divided by revenue 650,000 multiplied by 100. 40%. So in this formula we will have 40% in the numerator. So the break-even revenue becomes 600,000, 26D. Which statement relating to marginal costing are correct? Fixed production costs are included in inventory valuations. No, it is done only in absorption costing, not in marginal costing. Fixed production costs are fully written off as an expense. Correct. Variable production costs are included in the inventory valuations, which is true. Variable production costs are fully written off as an expense. No, only to the extent of goods sold are treated as an expense. Remaining is carried forward in the inventory value. So 2 and 3, 27C. A business makes and sells 4 products A, B, C, D. Which product should be produced first when labor hours are not sufficient? Basically, labor hours are in deficit, or they are the limiting factor here. So we'll have to calculate contribution per labor hour. Contribution will be selling price minus variable cost, then divided by the labor hour. For the first one, 10 minus 15, that gives a negative contribution, -5. In any case, even if you have spare labor hours, you will never produce a product with a negative contribution. So question or product A is out of question. Product B, 35 minus 10, 25, 25 divided by 5, $5 per labor hour. Then for product C, 50 minus 30, that divided by 2, so $10 per hour. And 75 minus 57, 18, 18 divided by 3, $6 per hour. So ranking, as per ranking, product C will be produced first, so 28C. 29. When does cost volume profit analysis inform users about cost behavior? When different time periods are involved and when absorption costing is used. Cost volume profit analysis has nothing to do with absorption costing. So option A is completely incorrect. When different time periods are involved and when marginal costing is used. Okay, this part is correct, marginal costing is used, but this part, when different time periods are involved, not really. Let's see, we might have a doubt in this statement. Then option C, when the level of output changes and absorption costing is used. Again, absorption costing is not related, so no. And then D, when the level of output changes and when marginal costing is used. Yes, this looks correct because cost volume profit analysis involves how the cost, contribution, revenues, all of this behave when output changes. If you increase or decrease output by a certain number, what would be the eventual change in the profit? So 29D. Question 30. Which statement about the budgets is correct? They are usually prepared by the board of directors, not necessary. They may be prepared by the top management, and sometimes in some organizations, the top management also involves the junior managers in the preparation of budgets so that they are more responsible towards it. They can identify limiting factors. Okay, let's see. This is a correct statement because once you have the budget, you know how much output you are supposed to produce, how much you are supposed to sell, what is the level of activity going to be, and then you compare it with your resources. Do we have the resources or do we have it in sufficient quantity to do this kind of activity? So it will help you identify limiting factors. But let's read all the options. They can only show monetary values, not necessary. And they have to be approved by shareholders. No, budgets have nothing to do with approval of shareholders. Only the final financial statements, the income statement, balance sheet has to be approved by shareholders. So 30B is the correct option here. So that completes our paper 13 also. I hope this video has helped you. You've understood how to analyze the questions and then do it properly. So if you did, please like the video, please share the video with your friends, and I'll see you in the next video.